The S&P 500 this morning getting above that 6,000 mark again. Our guest says we've seen this spectacular rally in the market, for example, from the April 8th low amid the height of tariff concerns. Let's get more now from Brian Mulberry, client portfolio manager at Zacks Investment Management. Brian, thanks very much indeed for joining us. When you look at the stock market right now, what are you paying most attention to? Is there any one or two things?
Well, there's been a lot of resiliency over the last couple of weeks, even in the face of some tension. Obviously, with what happened over the weekend in the Middle East, we still didn't see a really big drawdown like we did a couple of months ago when we saw pressure from tariffs. So just resiliency is the word of the day, I think, for the moment, in that you're finding really quality companies are still doing just fine. And a lot of the really bad stuff that was supposed to have happened really didn't. And so if you have a keen eye for risk and lean into higher quality factors, it seems like you can do okay in this market right now.
What about Mr. Trump's tariff war? Have people decided it's a taco market? Trump always chickens out if the disruption looks like it's too big?
Well, we certainly have seen a definable trend there, and I think that's added to some of the resiliency, or maybe even patience is a better word for investors right now, and that there is still 3 to 4 weeks before that July 9th deadline that's going to be incredibly important. If we get closer to that date and we don't have more specific information, in other words, deals done, but not just the announcement like we got from China, a framework, we want to see the level of detail like we got from the UK trade deal and how much it is going to benefit both sides. If we get more and more of those types of deals, you could see more resiliency from this market and maybe claw a little bit higher. But if we get to that point and we don't have more specifics to work with, there could be downward pressure as well as we start to get to that moment of, are we going to see another pause? Will Trump chicken out one more time? Or does this actually lead to the best case scenario, which is a free and fair trading environment that benefits both sides?
And you reckon some investors are maybe concerned about the possibility that this big tax bill can't make it through the Senate, and so that would force a reversion of corporate tax rates higher?
Yeah, absolutely. It's an underlying risk that I don't think gets enough attention because, to a certain extent, the tariffs are in our face every single day. But really, as a business or even as a consumer, you can avoid some of those tariffs just by changing your behavior, where you're buying your goods from, where you're sourcing components from. You can avoid through behavior changes some of that expense. Taxes, on the other hand, you can't get away from. And so if taxes were to go back to 2016 levels, that would impact everybody at the same time. And again, going from 21% back to 28% on a corporate level, that is a substantial headwind to earnings that I don't think gets enough attention in terms of a risk right now in this market.
Excuse me. A couple of names you like. They include JP Morgan. What's the attraction there? I mean, it is seen as a quality franchise.
Yeah, and really it's just about scale, right? The scale of operations. They have a number of different products. They're a global company. They're not overly reliant on any one segment of their business to drive profits. They're getting it from everywhere. In fact, some upside surprises even from the trading segment this last quarter. This is a company that has done very well at growing and growing productively, meaning they're not adding a lot of capital spend, but they're getting a lot of earnings growth. So that organic growth is one of the reasons we like JP Morgan so much right now.
Another name that you like, Walmart. If the economy stutters and if inflation besets customers, presumably Walmart will be seen as a low-cost solution by some buyers.
Yeah, absolutely. I mean, they definitely have some exposure to Chinese tariffs, but they said that really over the course of the entire year, it's only going to disrupt about 2 to 3% of their overall gross revenues. And they're not really planning on passing a lot of those costs through to consumers unless they absolutely have to. And so, again, a sense of durability when it comes to their ability to keep driving revenue. They've been investing in their digital footprint, competing directly with Amazon when it comes to home delivery. And they're showing that they're getting more and more wallet share from consumers. So again, just a company that in the face of some of these bigger risks and headwinds is still growing at a substantial rate.
Brian, leave us with a final thought. Are you tempted to reduce exposure to U.S. stocks right now, in the sense that we've heard a lot of talk about people cutting back on America because of unpredictability in Washington?
I think it's really a time to define clearly what you own and why you own it. And I think that there are a lot of good quality U.S. companies. I don't think you want to own the entire U.S. market. There is a lot of volatility that's baked into this level right now. There's probably a little bit more risk of downside than upside at the moment. And so you have to be very clear about what risks you're identifying and then try and manage them away from your portfolio. So I wouldn't leave the U.S. entirely. I would just be very specific about which U.S. companies I want to own through this period of volatility. And then on the back end of it, as we get through the second half of this year, we could actually see some pretty good news. If rates were able to come lower, if we do get a tax bill that adds stability, and then some trade deals, you could see how Q3 and Q4 might shape up to be a real boost for U.S. stocks. So I wouldn't want to leave them in this moment just yet.